Personal finance presentation. Other financial service providers. Prepare to get financially fit by practicing personal finance. Continuing on with our discussion of financial institution categories, breaking out those categories or those financial institutions into four main categories, starting with the deposit institutions we talked about in a prior presentation, non-deposit institutions we talked about in a prior presentation, other financial service providers, which we're going to talk about here, and in a prior presentation, we talked about non-bank financial service providers. We're looking at the other financial service providers, which we're going to be listing out: pawn shop, check cashing outlet, payday loan company, rent-to-own center, and title loan company. Note that some of these items might not be the first thing that comes to mind when you're thinking about financial services, and when you're thinking about loans. If you have access to other types of options, then that may be preferable. But in certain circumstances, you may not have access to other sources of financial services, and therefore some of these options are applicable in that case, and they do act as financial services. Starting with the pawn shop, the two primary ways pawn shop make money is by making personal loans and by reselling retail items. They make a loan to a customer who turns over the custody of an item that acts as collateral for the loan. So if someone comes in and they're going to say, hey, I need a loan, and the pawn shop says, well, if you give me something as collateral, then to secure the repayment of the loan, then that's what's going to basically be able to facilitate the loan, right? And then obviously if the loan isn't repaid with the interest, then you could lose the thing that you gave up for collateral for the loan. Because the risk of loan default is high, the pawn shop will charge the customer a higher interest rate for the loan than a traditional loan would. So obviously in these types of situations, the risk of default could be high, so that you're going to have a situation where generally you're going to have a higher interest rate, and you got the collateral on the line there, and obviously you're not working with a traditional type of bank where you might consider or think that there would be more kind of regulation with the traditional type of bank. So again, generally not usually the place you want to go for the loan unless you're in a situation where you would need the loan. You can understand in a situation where those loans are necessary that you're going to have a higher charging of the interest rate, and you've got the collateral in order to help secure the loan process. If the customer fails to repay the loan plus the interest, the customer forfeits the property put up as collateral to the pawn shop. Pawn shop can also make money from retail sales, so they may also purchase and sell things, or sell the things that they have claimed that as for collateral on the loans that were not paid. They can sell merchandise purchased directly from customers or items pledged as loan collateral from customers who subsequently defaulted on their loans. Then we have payday loans, so another kind of loan which is typically a short-term loan, and it's another situation where generally you would like to get a normal kind of standard loan if possible, because you would think there would be more regulations and controls in that type of market and possibly better interest rates. But if you need a short-term loan, then you do what you got to do and the options that you have. So it's a short-term, very high interest loans available to consumers. So once again, if you're looking at a loan situation where the risk of default is going to be high, then the way to compensate for that with regards to providing the loan is to have high interest rates to compensate for that. So it's usually based on how much you earn. You usually have to provide a pay stub when applying for one. So typically you need to prove what your earnings are so that they can get some kind of verification that you can pay back the loan. There have been laws to regulate the high fees and interest rates with the payday loans. So there's a lot of controversy in these types of loans, of course, because you look at them and you say, hey, compared to other financial loans, you're charging a whole lot of interest and fees on it. But again, of course, if you're in a situation where you need the loan at that point in time, and having those types of lenders can be good because they provide lending where other lending wouldn't be available, and the only way that would be possible under those circumstances, given the fact of the high defaults that would be applicable, is to have high interest rates and fees. So generally you'd want to stay away and get the lower rates and fees if you can get the normal financing. But if you're in need for the loan in the short term, the options are what the options are at some point. So rent-to-own center allows customers to rent consumer goods like furniture, appliances, home electronics, and computers by paying regular rental rates. the customer has the option to take ownership of the item after a certain number of payments has been made. So in essence, in other words, each rental payment is applied toward the sales price of the goods. Then we have the title loan company, a loan that requires an asset as collateral. So when we're looking at the title loan, then generally you're saying, hey, I'm going to use this piece of property for collateral, the most common being the car. So they are popular because they do not take into consideration an applicant's credit rating, and they can be approved very quickly. So you have a similar kind of situation with the pawn shop. If you're in a situation you can't get the normal kind of financing, but you need financing at this point in time, and you got to deal with someone who is going to be dealing with a situation where they're trying to lend money to someone who is a high-risk individual, then, and the credit rating possibly not good and so on, then possibly you can use the goods as collateral, in this case, that being the car. So, or some other kind of property, but the car often being the case. So a car title loan is the most common. The car is the easiest to put up as collateral. So a car is fairly conspicuous type of thing. There's a record of the car, ownership of the car, and so on and so forth. And therefore, it's a fairly easy thing to put up as collateral, as opposed to, say, a pawn shop or something like that. Then obviously the reason those things are easy to put up as collateral is because possession is going to be a large part of the law at that point in time, right? Whereas if you're talking about larger types of assets, then a title of ownership showing who has, the documentation of it for something that's fairly large and conspicuous like a car can be something that could be easily used, as a collateral kind of component to cover someone that defaults on the loan or doesn't pay the loan. So the cost of the title loans are often very high. So you have the similar type of situation where you're dealing with loan companies that are usually dealing with people who are high risk. That's why they have the title loans. That's why they need the collateral. And therefore, usually to compensate for that kind of situation, the lenders have higher rates and fees. So generally not something that you'd want to do if you have other types of options. But if you don't have other types of options, then, it is what it is once again at that point.